Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio, I've got Catriona Reed of Seven Investment Management. Welcome to the show.
Thank you.
And Richard Hunter of Interactive Investor.
Hi, Simon.
Now, it's that time of year again. Investors have slightly less than 1 month to invest their ISA. And despite the fact that they will have been told on many occasions over the past year that they shouldn't leave it till the last minute, the suspicion is that many people will have done. So, what can you do in order to shelter your cash in that tax-free wrapper and get invested? We're going to have a look at that in this show. But firstly, Catriona, why is it worth people investing in an ISA in the first place? I think we need to answer that question.
No, absolutely. So there are loads of benefits from investing in an ISA. The first being the tax efficiency of it. So you can invest in an ISA and it is essentially tax-free. So all capital gains tax, so the money that you invest, any growth that you get from that investment when you sell it is tax-free. You don't have to pay any capital gains tax. You also have the income tax benefit of not having to pay income tax and not having to pay dividend tax. So all in all, very, very good tax efficient way of investing, which also means that on your, when you come to do your tax return each year, it makes it a much easier process. ISAs are also really flexible now. So you can take money out of your ISA and put it back in the same tax year and still retain that tax efficiency. So for example, clients of ours, if they are selling a house, buying a new house, but they have to buy the house before managing to sell their old house, they can take monies out of their ISAs to help pay with stamp duty or to help put down a deposit. And then once they have sold their first house, then they can replace that money back into the ISA and have the tax efficiency around that money again. You also have the fact that you can actually invest quite a lot in ISAs these days. So you have a personal allowance of $20,000 per person. So if you're a couple, that's £40,000 you can put into a tax-free environment for investing. If you have children, you can start doing inheritance tax planning by putting monies in JISAs for them or lifetime ISAs. So all in all, you can put quite a lot of money into investments which don't have tax associated with them. You can now also, at death, you can pass on your ISA to your surviving spouse and it retains that tax shelter as it is transferred. So lots of benefits.
And I suppose there's a lot of people out there who think, well, hang on a minute, I've got capital gains tax allowance of 11,000 something, a year. I'm never going to make a capital gain that's bigger than that. But there are situations where people do. I mean, it might be that you spend a lifetime investing and then you want to pull a big chunk of money out, and that means that you have to sell quite a few investments. Or another common scenario that crops up is, for example, someone inherits a property. The property goes up in value between the time when they've inherited and when it's been sold, or they might sell a buy-to-let. And all of a sudden, that eats up their whole capital gains tax allowance. And then they find that they're in a scenario where they can't even buy and sell their investments without incurring a tax charge.
Very true. And you also, if you have been doing ISAs religiously year on year, you now have ISA millionaires, and there will be huge capital gains because they've been invested for that length of time that, when they do decide to take money out or sell, that will be tax-free.
So we can understand the benefits of them, but with 1 month to go, are people a bit more nervous this ISA season? I mean, we've had the stock market wobble at the start of the year. Things have picked back up again since. But people do seem to be slightly nervous. Is that the case?
I mean, we have had volatility come back in markets. We were talking just earlier, the FTSE is down about 6%. The European, so the Euro stocks is down about 6%. So volatility has come back into markets. And obviously that is more challenging for investors. And it's natural to be a bit cautious when markets are going down. But I think you have to put it all into perspective. The global economy is growing. Business confidence is good, consumer confidence is good, company earnings generally in the whole are quite good. I think investors became quite complacent. We've had 9 years of rising equity markets, and last year is a prime example. We had equity markets that were on a positive trajectory, and they were ignoring all the risks out there. Political risk isn't a new thing. It has been there for quite a while, and markets were ignoring that. Markets were at all-time low volatility. So we're talking about 50 years. It's the lowest volatility we saw last year. So I would say that's abnormal. What we're seeing now is much more normal for markets. Markets go up and down. But longer term, if you should look through that. We do think that actually this can be a positive year for markets.
And of course, the other beauty of an ISA is the flexibility that it gives you in that if you put your £20,000 in, you don't need to invest it straight away. You can leave it there until such time as you feel it's right. So the most important thing is not to lose your allowance as opposed to when you start investing the money, because obviously in over March and April you can be putting £40,000 in individually because you're straddling the tax year, and then decide as and when to actually invest that money.
And also, it's probably a good time to start dripping in assets into the market. You have seen volatility, but that gives you opportunity to actually get some money in at lower prices going forward.
And it's true though. I mean, when prices are down, when markets are soft, if you're a long-term investor, you're buying at a discount to what you would have been at the tail end of last year. One market that is particularly soft at the moment and investors seem to be particularly not so keen on, though, is the UK itself, isn't it, Richard?
Yeah, there was a Bank of America survey of international investors, about 163, so a significant amount. And they cut it into 22 asset classes, either by index or by sector, or even by traditional asset classes, the likes of cash, for example, bonds, etc. And bottom of the list out of the 22 asset classes was actually UK equities, even below cash. This is the way that institutional international investors are looking at the UK at the moment. The obvious thing that they're mentioning, of course, is Brexit uncertainty, and also a clouded outlook in terms of corporate earnings, which is quite interesting because it comes at a time when the Bank of England has sort of said, well, we had to do QE, we've had low interest rates, so obviously the knock-on impact of that is no one really wants to be in bonds and cash. Trouble is, pension funds have to be in bonds and cash, so they've been underperforming. So what excess money companies have had, whereas otherwise they might have been investing that money in their own business, technology and so on, they're plugging pension deficits. So that's been a drag there as well. So obviously, from a sort of 30,000 feet, it looks as though international investors may be shunning UK equities, but for people watching the show now or seasoned UK investors who take that bottom-up approach, the fact remains there are any number of quality UK companies if you go on a bottom-up approach rather than top-down. And clearly, if we are currently out of flavour with the international investing marketplace, we could be looking at a couple of opportunities square on at the moment.
I mean, intriguingly, Catriona, it's not just the international investors who are shunning the UK, it's UK investors as well. I mean, the investment association stats that show, net retail fund inflows, so what individual investors are doing with their money, what they're buying in their ISAs, over the past year has shown them, pulling money out of UK equities and even pulling money out of UK equity income funds, which is a real surprise, but putting money into bond funds. When we've got a scenario where there is a concern that bonds are about as expensive as they're going to get, yields are about as low as they're going to get, and that could turn around. Are some of these investors who perhaps are thinking that they're doing something less risky, exposing themselves to more risk?
Yeah, I think that's absolutely right. I mean, I don't know how long we've been talking about the bond rotation coming, but, it is still our view that actually, those bonds do pose a risk because in a raising rate environment, the underlying bond capital value will come under pressure. So we've been underweight bonds for a very long time. Within the bond market, there are pockets of value. We like emerging markets. They are actually giving you a yield of about 5%. The governments there have a lot more money than the governments in the developed world. So the default risk is lower. Obviously, there is risk associated with emerging market bonds, and that mainly comes from the currency. But the currency in emerging markets is actually devalued, so you might get an uptick with emerging market currencies appreciating as well. But generally, we would say you should be underweight developed market bonds generally, and you should look at more kind of alternatives to try and get that sort of a return going forward.
And is there any way people investing their money into their ISA over the next month could kind of mitigate their risks? I mean, Richard talked about the fact that obviously you can put your money in and you don't have to invest it all in one go. That's one way of
Yes.
doing it. But is there any way, if they think, I am a bit nervous, what can I do to just lower the risk down a little bit?
So I think that, there's quite a few things. I think when you're investing, obviously, firstly, you have to have a long-term viewpoint. So that's the first thing, have a 5-year viewpoint. And then you have to look at kind of what you're trying to achieve, the objectives you're trying to achieve, as well as the risk that you're willing to take. There's no point in taking a huge risk if you can't sleep at night. So it's looking at that. And then not having all your eggs in one basket. So having a spread of investments across the different asset classes, and making sure that is kept up to date. So you can outsource to a manager, a fund manager, who does that for you, who will look to take the opportunities as they arrive and allocate more money to them, but also looking very closely at where they perceive the risk to be and taking money away, as well as having some risk mitigation tools within the portfolio. So, for example, within our client portfolios, we've used quite a lot of put options, which is essentially insurance against a fall in the equity market. So we had one on the S&P 500 and the Eurostoxx index. So when we saw that volatility coming back, those assets tend to do well.
Mm-hmm. And people need to think as well, if they're investing in shares. Richard, I know you're a big fan of the total return of the dividend that gets paid to you year in, year out, and not just think in terms of index prices, don't they?
Yes, as we've mentioned many times on the show, the eighth wonder of the world, as described by Einstein, compound interest. And again, the FTSE 100 is yielding on average about 3.5%. That's still a good return by any metric. It means that if we have a situation similar to last year, where the kind of straight line value FTSE 100 was up about 6%. That's a 10% return in 1 year, because you're adding those divvies in. Once compound interest starts to kick in, and you're effectively continuing to add to your holding without having to pay for it, the figures are, over a long period of time, they're just quite astonishing. The difference between a straight line gain and a compounded gain. And again, if you are very much taking a 5-term view at least, you will start to benefit from the compound interest, let alone whether you pick the right companies. You'll really start to see those returns kicking in before you know it.
So what would your top tip be for someone looking to invest some money in their ISA between now and April? What's the thing they should think about doing?
I think the risk element is absolutely vital. If for example, and assuming you don't want to invest in a tracker, if you're looking at individual shares, if you've got a low risk tolerance, you're probably going to look at something like a defensive share, a utility perhaps. Boring though they are, they also usually come, because of their stable cash generation, with a reasonable dividend yield. And if you want something to put away for 5 years, you could look at something which is a quality UK company, such as Prudential, for example. You've got the baby boomers in the States. You've got more people in the UK having to make their own pension provision as time goes on, let alone their exposure to the Asian markets, where the burgeoning middle class will increasingly start to save. So that could be interesting and fulfilling as that story unfolds, if you were invested in the likes of Prudential. But even as we said earlier, within the FTSE 100, there are plenty of world-class companies, despite what institutional international fund managers might be thinking at the moment.
And what would your best piece of advice be for someone investing in their ISA, Catriona?
Well, if it was me, I would consider myself still quite young. Many would disagree, maybe, but I would kind of look to probably have a long-term view with equities. I would have the core being managed by a fund manager who is making those decisions on an ongoing basis, keeping the portfolio up to date. And then I would probably have some satellite investments, maybe some in frontier markets. I think it's one of the places that's very kind of misunderstood and misrepresented. A lot of people think that, they're just made up of those oil producing companies, but actually they are now part of that low cost manufacturing base. So in 20 years plus, they will be the new emerging markets. And interestingly, they are quite uncorrelated to the rest of the global markets. So, when we have seen the volatility come in this year, VIX Golden, is that what they call it now? VIX Golden. Actually, frontier markets held up pretty well. So I would take a long-term view and have a little bit invested in frontiers.
And my top tip, viewers, would be don't leave it till the last minute. Don't leave it till the last day or two, because things can and do go wrong. Invariably, investment websites are not perfect. You try to pay your money in, your money doesn't go in, you end up losing out on the money that you wanted to put in this tax year. So try and do it at least a week in advance, eh? Catriona, thank you very much.
Thank you very much.
Richard, thank you very much.
Pleasure.
Thank you very much for watching. Goodbye.